Hello and welcome to Finextra. I'm Josie Waite and I'm here at the SAP FSI Forum with David McCarthy from Atom Bank, and we are talking about using technologies to tackle inefficiencies in banking. Thank you for joining me, David.
Thank you very much.
In the finance area, banks increasingly look to leverage analytics in real time. What are the opportunities and advantages of this?
Okay, well I think finance, particularly in banks, is often seen as a slow-moving thing. It responds to circumstances at quite a slow pace. Traditionally, things like budgets, which are set annually, long-term plans of that nature. But the world changes much more frequently. Interest rates change more frequently, circumstances change more frequently, and you find you may have surpluses of capacity or an opportunity to respond to different things. By providing much more responsive information and more accurate information, we can make better decisions more quickly, and we think that translates into a better product for the customer and a better return for our shareholders.
How does this help decision making in banks?
I think decision making then becomes more frequent and it becomes more rational. As I say, typically banks rely on long-term forecasts and don't adapt very quickly. If you can respond in a fraction of a second to excesses in capacity, changes in market circumstances, changes in interest rates and so on, you can make much better decisions. And by making better decisions, as I say, that translates into more value for both customer and shareholder.
What are the benefits to customers and shareholders?
Well, the most obvious thing in a bank is you can provide a better product. And not exclusively, but in large part, that's about the pricing of the product. The pricing of the product depends on the cost of production, like in any industry. In our case, the cost of production is a little bit more abstract. It depends on things like capital and liquidity and so on, but also the processing costs. If you can minimise those things, because you understand the situation better, you respond more quickly, you can provide a cheaper product. But it's not just about price, it's also about other frictions, like a long time to make decisions, uncertainty of decision making, complexities of standing in queues and waiting for telephones to be answered. All those sorts of things are reflected in the customer experience and do translate into perhaps less loyalty, less brand quality, and that should be reflected in your returns to shareholders.
That's great. Thank you very much, David.
Thank you. Nice to speak to you.
And thank you for watching.